In 1943, the United States government introduced paycheck withholding, and overnight, Americans stopped feeling their taxes leave. Before that year, every worker wrote a check to Washington himself, once a year. He felt every dollar. Politicians knew exactly what they were doing. Number 11 on this list shows what else changed that same year, and why it was never taught in any classroom after 1965. Number 4 existed legally for 30 years before a single memo quietly ended it. No vote, no debate, no announcement. Subscribe before we start. Some of what follows was buried on purpose. Number 20, the tax-free saving account that banks killed. From the early 1900s through the 1960s, millions of American families used Christmas Club accounts, locked savings accounts at local banks that released funds every December 1st. Deposits were small, 50 cents to $2 weekly, but the account was untouchable until the release date, which meant the money was genuinely saved. At its peak in 1960, over 17 million Americans held these accounts. Banks eliminated them not because customers stopped wanting them, but because credit cards earned billions while Christmas clubs earned almost nothing in fees. The government never protected the product. It had every reason not to. Number 19. Property tax appeals. Your grandfather felled without a lawyer. Through most of the 20th century, appealing a property tax assessment was a straightforward civic act. You walked into the county assessor's office, presented your case, and received a hearing within weeks. No attorney required, no filing fees, no intimidation. Working families in the 1950s routinely reduced their assessments by 10 to 20% simply by showing up and knowing 3 basic questions to ask. Today, the appeals process in most counties requires documentation, legal language, and filing deadlines buried in county websites most homeowners never find. The right still exists. The access has been systematically complicated until most people simply pay whatever number arrives in the mail. Number 18. The installment sale method that let families spread tax over years before tax reform restricted its use. An American selling property or a small business could spread the taxable gain across multiple years, paying tax only as payments arrived rather than all at once in the year of sale. A farmer in Kansas who sold 20 acres in 1968 and received payments over 5 years paid tax on each payment as it came. His effective rate stayed manageable. He never faced a single year of catastrophic tax liability. The installment sale method still technically exists today. What changed were the restrictions. Property types excluded, recapture rules added, passive loss limitations applied, until the version available to ordinary Americans bears little resemblance to what their grandparents used freely for decades. Number 17. Hobby loss deductions before the IRS decided your passion was not real. Before 1969, an American who pursued a side activity, woodworking, farming a small plot, breeding dogs, making furniture, could deduct losses from that activity against ordinary income, provided the activity had any reasonable profit motive. A machinist in Tennessee who raised horses on weekends in 1962 and lost $400 that year deducted those losses from his factory wages. The IRS did not question his sincerity. The code assumed Americans pursued activities with legitimate economic purpose. The Tax Reform Act of 1969 introduced the hobby loss rules. Now the IRS presumes an activity is a hobby unless you prove otherwise, reversing the original burden entirely. Millions of working Americans lost deductions overnight without a single change in their actual behavior. Subscribe right now. Number 7 on this list is the secret that stayed hidden longest. You need to be here when we reach it. Number 16. The income exclusion for Americans working abroad. Before, the foreign earned income exclusion was restricted through the 1970s and 1980s. Americans working outside the country enjoyed significantly more generous tax treatment on their overseas earnings. A contractor working in Germany in 1961 excluded a meaningful portion of his foreign salary from U.S. taxation entirely. The code recognized that Americans abroad faced double living costs, paying taxes to both the host country and Washington simultaneously. Successive reform acts narrowed the exclusion, added complex tests for physical presence and bona fide residence, and introduced limitations that effectively reduced the benefit for middle-income workers while leaving it largely intact for higher earners who could structure their arrangements accordingly. Number 15. Averaging gifts and inheritances before the rules changed. Through much of the mid-20th century, receiving a modest inheritance or family gift triggered far more favorable tax treatment than today's framework applies to the same transfer. A daughter in Ohio who inherited her father's modest savings in 1959, faced minimal federal tax implications on that transfer. The code treated the movement of accumulated family wealth as something different from earned income, recognizing that taxing a lifetime of already taxed savings a second time upon death served no purpose ordinary Americans could understand or accept. Estate and gift tax thresholds, exemptions, and treatment have been rewritten repeatedly since the 1970s. Each revision adding complexity while shifting who benefits from available protections and who pays the full rate regardless. Every secret removed so far had one thing in common: ordinary families used them. Ordinary families benefited from them, and when they disappeared, ordinary families paid more, while the mechanisms that replaced them consistently served a different class of American entirely. What follows is where the pattern becomes impossible to call coincidental. Number 14. The unlimited charitable deduction available to everyone. Before 1969, charitable deductions for individuals had no percentage ceiling. If you donated half your income to your church, your local hospital, or a community organization, you deducted half your income. No cap, no phase-out, no limitation based on what you gave relative to what you earned. A factory worker in Alabama who tithed faithfully through the 1950s deducted every dollar of that tithe from his taxable income without restriction. The code treated generosity as a straightforward reduction in taxable resources, because that is exactly what it was. The Tax Reform Act of 1969 introduced percentage limitations on charitable deductions for the first time. Today, cash donations to public charities are limited to 60% of adjusted gross income. The deduction still exists, but the ceiling ensures that the Americans most likely to give proportionally large shares of modest incomes face restrictions that the wealthy, giving from surplus, never meaningfully encounter. Number 13. The completed contract method of small builders once used. Before accounting method restrictions arrived through the 1980s, small contractors and builders could defer recognizing income on long-term projects until the contract was fully completed, and pay tax only in the year the job was done. A home builder in Georgia who spent 18 months constructing a house in 1965 recognized no taxable income until the keys were handed over. His tax liability arrived in the same year as his payment, matching the timing of his actual cash flow. The Tax Reform Act of 1986 restricted the completed contract method severely for most contractors. Income recognition became required as work progressed, meaning builders paid taxes on money they had not yet received from jobs not yet finished during periods when cash was often tightest. Number 12. The interest exclusion on state and local bonds. For most of the 20th century, interest earned on state and municipal bonds was excluded from federal taxation entirely, and this benefit was available to any American who purchased them, regardless of income level. A retired postal worker in 1962 who placed his savings into local government bonds earned interest completely free of federal tax. The exclusion rewarded Americans for supporting local infrastructure, schools, roads, water systems, with their personal savings. Over successive decades, the alternative minimum tax progressively captured this income for higher earners, while the practical accessibility of municipal bonds for ordinary working Americans declined as minimum purchase requirements and broker fees effectively priced out the families the original exclusion was designed to serve. Something worth saying plainly before we reach the final items. None of what you have heard today is conspiracy. Every removal is documented. Every change has a public record. Every restriction has a named author and a recorded vote. What was never recorded, what was never announced or taught, was the cumulative effect on the families who lost these protections, one quiet revision at a time. Your grandparents knew what they had. Most of their grandchildren never learned what was taken. Number 11. Withholding and what changed the moment it arrived. Before 1943, Americans paid taxes once a year, writing a check to Washington for money sitting in their own accounts. They felt every dollar leave. Politicians who raised taxes faced citizens who experienced that increase directly and immediately. Paycheck withholding changed the psychology of taxation permanently. Money left before workers ever touched it. The pain of payment disappeared, and with it went the vigilance that had kept tax rates and code complexity within limits ordinary citizens could monitor and resist. The withholding system was sold as wartime convenience. It was never removed when the war ended. Number 10. The household employee deduction that covered real family help. Through the mid-20th century, families who employed household help, a housekeeper, a caretaker for elderly parents, a child care worker, could deduct those wages from taxable income under provisions far more accessible than today's requirements. A working mother in 1957 who paid a neighbor to watch her children while she worked at the telephone exchange deducted those payments straightforwardly. The code recognized that enabling a second income required real expenditure deserving real recognition. Today's nanny tax requirements, Social Security contributions, Medicare withholding, quarterly filings, annual W-2 preparation have made the formal employment of household help so administratively complex that most families either pay cash informally or go without help entirely. Number 9. The General Utilities Doctrine that protected small business sellers. Before its repeal in 1986, the General Utilities Doctrine allowed corporations, including small incorporated family businesses, to distribute appreciated assets to shareholders without recognizing gain. A family that had built a small incorporated business over 30 years and held appreciated property inside that structure could distribute those assets upon selling without the corporation paying tax on the appreciation. Only the shareholder paid once. The Tax Reform Act of 1986 repealed the doctrine entirely. The same act, the same session. Small family businesses that had structured themselves reasonably under existing laws suddenly faced double taxation on assets their parents had spent decades accumulating. Number 8. Accelerated depreciation before it was taken from ordinary owners. Through the 1950s and 1960s, property owners could depreciate assets, buildings, equipment, vehicles, on accelerated schedules that front-loaded the tax benefit into early years of ownership when cash was often needed most. A landlord in 1961 who purchased a modest rental property could depreciate it aggressively in the first 5 years, reducing taxable income substantially during the period when mortgage payments were highest and maintenance costs were unpredictable. Tax reforms through the 1980s standardized depreciation schedules and extended recovery periods, eliminating the front-loaded benefit that had made property ownership financially accessible for working families taking their first steps into real estate investment. Number 7. The secret that stayed hidden longest. From the founding of the federal income tax in 1913 until well into the 1950s, administrative practice allowed working Americans to claim deductions for ordinary business-related expenses with minimal documentation, based on reasonable estimation and good faith reporting. An electrician in 1948 who estimated his annual tool and supply costs at $400 and deducted that figure faced no challenge from a revenue service that trusted the word of working people filing honestly. The shift toward documentation requirements, receipts for everything, mileage logs, contemporaneous records, arrived not through legislation but through enforcement posture changes inside the IRS itself. No vote, no law. A quiet internal decision that placed the burden of proof permanently on the taxpayer rather than the government. Number 6. Loss carrybacks that once gave struggling families immediate relief. Before carryback provisions were restricted through the 1990s, a family business that suffered a devastating year could apply that loss against taxes paid in previous profitable years and receive a real refund check within months. A bad year once had a built-in recovery mechanism. The government that had taken money during good years returned some of it during hard ones. That reciprocity was removed. Losses now carry only forward into a future that struggling businesses sometimes never reach. Number 5. The pension deduction before employers became required intermediaries. Before retirement savings rules were restructured through the 1970s and 1980s, working Americans could establish and fund retirement provisions independently, without requiring employer sponsorship to access the full tax benefit. The restructuring tied meaningful retirement tax advantages to employment status and employer plan availability. Workers between jobs, self-employed Americans, and contract workers found their options progressively narrowed until the system rewarded only those whose employers chose to participate. Number 4. The administrative change that required no vote. In the late 1970s, IRS internal guidance quietly reclassified certain long-standing deduction categories, not through legislation, but through enforcement memo. Millions of Americans who had claimed the same provisions legally for years suddenly faced audit risk for doing exactly what they had always done. Most stopped claiming, not because the law changed, because the threat did. Number 3. Proportional taxation before bracket creep arrived. Through the early decades of the federal income tax, bracket thresholds were adjusted periodically to reflect wage growth, ensuring that a factory worker whose salary kept pace with inflation did not gradually move into tax brackets designed for genuinely higher earners. Not when bracket indexing was removed during certain reform periods. Inflation alone pushed millions of working Americans into higher marginal rates without a single congressional vote raising their taxes explicitly. Number 2. The capital loss deduction before annual limits arrived. Before annual capital loss deduction limits were established and progressively reduced, Americans who suffered investment losses could apply a greater portion of those losses against ordinary income in the year the loss occurred. A retired teacher in 1955 who lost $800 in a failed stock position deducted the full amount against her other income. That year, the code recognized that losses were real, immediate, and deserved recognition in the year they happened. Today, capital losses in excess of $3,000 carry forward into years when the investor may no longer be living, working, or positioned to benefit from the deferred relief. Number 1. The understanding that made all of this possible. This is not a deduction. It is not a loophole. It is not a trick. It is the understanding that your grandparents carried into every April, that the tax code is not a fixed natural law handed down unchanged from above. It is a document written by people, changed by people, and shaped by whoever understood it best and paid closest attention to its revisions. Your grandparents paid attention. Someone sat with them at the kitchen table and explained what was available, what had changed, and what was worth claiming before it disappeared. That tradition of paying attention, of knowing what exists before it is removed, is the only tax secret that cannot be legislated away. It was not taught in schools. It was not published in newspapers. It was passed down at kitchen tables, in barber shops between neighbors who looked out for each other. Now you have it. The question is the same one it has always been, whether you pass it on or let it disappear. Again, the next video covers 5 of these protections that still exist in the current tax code, available right now, unclaimed by most Americans who qualify for them. Subscribe so you do not miss it. Your grandparents never left a legal dollar on the table. Neither should you.